At 9:32 a.m. on an ordinary weekday, a market somewhere in the world breaks. Not with a crash, not with panic on television, just a tiny malfunction, a delay measured in milliseconds, a model that assumes something will happen that doesn't. By lunchtime, nobody notices. By the end of the week, a regulator files a report that says everything was within expected parameters. And 6 months later, a crisis explodes that no one can quite explain, except in hindsight. This is how modern financial risk is born. Not loudly, not illegally, but faster than the people paid to watch it can possibly keep up. And that's the uncomfortable truth we're going to sit with today. Markets now create risk at a speed and scale that regulation was never designed to see, let alone control. This matters right now because the financial system you live inside today is fundamentally different from the one that existed even 15 years ago. Not bigger, faster, not more complex on paper, more automated in reality. And not centered around humans making decisions, but around systems reacting to systems, often without a clear off switch. Most people imagine financial crises as events: a crash, a bubble popping, a villain, a bad decision. In reality, modern crises are usually the result of perfectly reasonable actions interacting at machine speed. No single bad actor. No single red flag, just feedback loops stacking on top of each other until the system tips. To understand why regulators are always late, we have to understand how markets actually work now, not how they're described in textbooks, or how they looked in old movies with shouting traders on exchange floors. Let's rewind.
For most of modern financial history, markets were slow. Orders were placed by phone. Trades were written down. Risk traveled at human speed. If something went wrong, there was time, sometimes days, for humans to notice, argue, intervene. Regulation evolved in that world. Rules were written assuming delays. Reporting requirements assumed paperwork. Stress tests assumed scenarios that unfolded over quarters, not seconds. Oversight assumed you could freeze a market, gather information, and then act. But markets didn't stay still. Technology arrived quietly at first. Electronic trading, faster settlement, algorithms designed to execute trades more efficiently than humans ever could. Then faster data feeds. Then co-located servers sitting inches away from exchanges to shave microseconds off execution time. Speed became an advantage, then a necessity, then the entire game. Today, huge portions of global markets are run by algorithms reacting to price changes created by other algorithms reacting to signals generated by still more algorithms. Humans design the rules, machines play the game, and the game never sleeps. Here's where the risk starts to slip out of view. Imagine a single trading strategy. By itself, it's harmless, conservative even. It buys when volatility is low. It sells when volatility spikes. Perfectly sensible. Now imagine thousands of funds using variations of that same logic, not because they copied each other, but because the math leads them there, the incentives lead them there, the data leads them there. Individually, each fund looks fine. Collectively, they become a crowd.
When volatility rises slightly, they all try to sell at once. Liquidity thins. Prices move faster. Volatility rises more, which triggers more selling. No one planned this. No one coordinated it. But the outcome is the same as panic. This is a feedback loop, and feedback loops are the defining risk of modern markets. They're hard to see because they don't live on balance sheets. They live in correlations, in timing, in assumptions that only break under stress. And here's the key problem. Regulators mostly monitor institutions. Markets mostly break at the system level. A bank can pass every regulatory test and still be part of a structure that collapses. Because risk today isn't just about leverage, it's about synchronization. A hedge fund borrows from a prime broker. That broker hedges exposure using derivatives. Those derivatives are cleared through a central counterparty. That counterparty relies on margin models calibrated to normal conditions. At no point does any single entity appear dangerously exposed. At no point does a regulator see a flashing red warning. But the system as a whole becomes tightly wound. All it takes is a move that's slightly outside the model's assumptions. And when that happens, the reaction is mechanical. Margins are raised automatically. Positions are liquidated automatically. Liquidity disappears automatically. Speed replaces judgment.
This isn't theoretical. We've seen it. The flash crash, the collapse of volatility products, the sudden failure of funds that looked safe days earlier, the scramble for liquidity in March 2020, when even U.S. Treasury markets, supposedly the safest in the world, started to seize. That moment should have terrified regulators more than it did. Because treasuries don't panic. They're the panic button. Behind the scenes, leveraged funds were forced to unwind positions at the same time. Dealers, constrained by post-crisis balance sheet rules, couldn't absorb the shock. Prices moved too fast. Bid-ask spreads exploded. The system did exactly what it was designed to do. It just wasn't designed for itself. Many regulations made institutions safer, but pushed risk elsewhere, into hedge funds, into private credit, into opaque corners where leverage is harder to see and harder to stop. Regulators are always regulating the last crisis. Markets are already building the next one. Modern markets are resilient to small shocks and dangerously vulnerable to the wrong ones. Which leaves an uncomfortable question. If risk is created faster than it can be observed, if crises come from interactions, not villains, if stability itself creates fragility, then what does control even mean anymore? Maybe the real danger isn't the next crisis. Maybe it's believing we'll recognize it in time.